And they've consistently made the point in their forecast they want to keep real yields at sort of 1.5 percentage points. So the Fed funds rate 1.5 percentage points above core PCE. But PCE is coming down pretty quickly, so we still think that you're going to get a few disinflationary rate cuts before you then get what we think will ultimately be recessionary rate cuts in early 2024. But for the moment, you're right, absolutely right. If PCE stays high and the Fed wants to stay tight, as their rhetoric suggests, then we could be in for a higher for longer environment for a bit longer yet.
Well, the other language from Logan is that is inflation low enough? And that will be key, right? We've made enormous inroads into getting inflation down from those higher ranges of the high single digits to what is a low single digit number, but it's still not 2%.
Yeah.
So closing that gap is quite key from here.
Yeah.
What do markets do in that context? Because there used to be this view that as soon as you get sight of the Fed turning, then look, rush into equities now. But if we are talking for higher for longer, then there really is no rush.
Yeah, that's right. When you look at economic surprise and you look at how markets are behaving, it's interesting that the market is taking bad news as good news. And that's been the case since there was the talk of the pause starting in June. As soon as there's an idea that the Fed might be able to engineer a soft landing, do some rate cuts without damaging growth, that's pretty good. You know, you can factor more equity valuation into what is still a fairly lofty profits environment. The reality is, ordinarily, when you're getting disinflation, it's because the economy is weakening. And if the economy weakens enough, it's not just a soft landing disinflation. You actually, the first rate cut is usually when the Fed needs to cut rates to try and stimulate activity because it's too weak. So we're still of the opinion that while things are slowing linearly towards back towards trend at the moment on many fronts, and the soft landing is definitely a possibility, that these lags are only just starting to kick in. You're seeing lags in home building, in autos. You've got private credit filling the absence of lending from large banks to some extent. So lots of lags coming through. It will also be the case that as the economy slows, it won't naturally recover back into growth just with a disinflationary rate cut or two.
Gerry, were we perhaps a little bit naive, having seen the bond yields even slip off just a little bit not so long ago, and now they're perhaps coming back up again on the chances that actually there could really be, and maybe it was because they weren't believing the narrative that actually we are going to stay here for a little bit longer. Is that really the case? Was it a sense of naivety, perhaps, even from the market's perspective?
Perhaps. It's hard, though, because with long-term bond yields, you've really got to factor in what is going to be the average overnight Fed rate for that entire period. Yeah. And so for a long while through this rate hiking cycle, there was an expectation there would be a recession that would take rates possibly back to zero. So you can factor, between the peak and the trough, you get somewhere in between as a 10-year yield. The reality is now, if you get a soft landing, rates aren't going back to zero. They might come down a little bit. And so actually your weighted average of yields through multiple cycles where you're not at zero is a higher level. Compounding that also is that oil prices are rising again. So we've been long energy producers. We prefer those over autos, and Patrick Hummel actually had a great piece on why European autos are a good underweight at the moment, particularly some of the mass market companies. But coming back to energy, that resurgence of higher energy prices is perhaps also part of the reason that yields are staying more elevated, that perhaps the disinflation we're seeing may reverse somewhat.